With U.S. markets closed for the weekend, we can see that Rezolve AI PLC, ticker RZLV, ended the week on Friday, November 14, 2025, closing at a price of $2.97 per share. It was a rough session, closing near the low of its intraday range, which stretched from $2.94 up to $3.23. The trading volume was immense, clocking in at over 15 million shares, a figure that is dramatically higher than its average, and points to significant distribution and selling pressure. When you see volume like that pushing a stock down to its lows, it's a clear signal of capitulation, not confidence. This isn't a quiet day of online investing. This is a battlefield. And what's fascinating and deeply concerning is the profound disconnect between the story this company is telling and the story the stock chart is showing. The immediate expectation for many investors, especially those doing their self-investing on a platform like the Robinhood app or SoFi Invest, is that a company with AI in its name is the next big thing. They hear AI and they immediately think of the wealth creation of Nvidia stock. They read press releases about executives joining from Apple and Google, and they see analyst price targets of $9, $10, even $15 a share. The expectation is that this $2.97 price is a generational bargain, a ground floor opportunity. But the reality, when you look at the numbers and the price action, is that RZLV is behaving less like the next Apple stock and more like a classic high-risk post-SPAC collapse. The stock has fallen over 27% in the last week and a staggering 41% in the last month. This isn't a dip, it's a descent. The common belief, the story the company is actively promoting, is that Rezolve AI is at the forefront of what it calls Agentic Commerce. The narrative is compelling. They claim to be building a platform powered by their own proprietary large language model that will allow AI agents to autonomously conduct transactions for consumers. It's the kind of forward-looking story that gets people excited, the same way Tesla stock captured the imagination of investors about the future of transportation. In the last few weeks alone, Rezolve has put out a flurry of news. They announced a major $200 million oversubscribed financing round. They've announced the hiring of senior executives from some of the biggest names in tech, including Apple and Microsoft, to lead their global sales charge. They are targeting an ambitious $500 million in annual recurring revenue by the end of 2026. This is the expectation, a well-funded, aggressively staffed AI company on the verge of explosive growth. When you read this, you feel like you should be logging into your Fidelity brokerage account or your individual brokerage account at Interactive Brokers and buying with both hands. The analysts are certainly painting that picture with strong buy ratings almost universally. They see the $200 million in financing, they see the high-profile hires, and they are projecting a massive ramp-up in revenue. This is what you'd want an automated tool like Schwab Intelligent Portfolios to see. But then we have to look at the reality. The reality is the $2.97 stock price. The reality is the chart that shows a stock that hit a high of over $14 earlier this year and has been in free fall ever since, wiping out billions in market capitalization. The reality is found in their financial statements. The expectation is a $500 million revenue target in 2 years, but the reality is that for the 6 months ending June 30th, 2025, Rezolve AI generated just $6.32 million in revenue. For the entire year of 2024, their revenue was a minuscule $187,000. The disconnect is jarring. Even more telling, to get that $3.16 million in revenue in the quarter ending in June, the company posted a net loss of $28.93 million. This isn't just a company that's not profitable. This is a company that is burning cash at a truly breathtaking rate. Its net profit margin is negative 4,000%. It has negative shareholder equity. This isn't the financial profile of Nvidia stock or Apple stock in their growth phases. This is a company in a desperate race against time. And the recent $200 million financing wasn't for growth, it was for survival. It was to fund these massive losses and to pay for its recent acquisitions like Group Buy, which was an all-equity deal. This also brings up the other harsh reality: dilution. The company's own filings and analyst reports point to the fact that shareholders have been substantially diluted in the last year. That $200 million in financing, it came at a cost, likely by selling new shares at prices that hurt existing holders. So let's analyze this recent brutal stock movement. That 15 million share volume day on Friday wasn't retail investors using the Robinhood app getting excited. That was likely institutional selling, or perhaps a massive block from an early SPAC investor, or a financing participant whose lockup period expired, finally dumping their shares for whatever they could get. When you're trading on a sophisticated system like the Interactive Brokers trading platform, you're watching the Level 2 order book, and you can see the massive sell wall stacked up. This isn't a healthy consolidation. The stock is breaking below key psychological levels. It's failing to find support. Every small bounce is being sold into, which is classic bear market behavior for a single stock. This is the kind of investment that could easily go to its all-time low of $1.07 or even lower before it ever gets close to those analyst targets of $10 or $15. For anyone considering investing sites and looking at this, the risk is enormous. This is not a stock you put in your Fidelity IRAs and forget about. This is not something you'd find in Fidelity mutual funds or most Fidelity ETFs. This is a pure high-stakes speculation. You have to ask yourself, are you betting on the story or are you trading the reality? Because right now, the story and the reality are in different universes. So what does Rezolve AI actually do? The company's focus is on mobile commerce and e-commerce engagement. Their idea is to make everything you see on your phone, from a social media post to a streaming video, an instant point of purchase. Their Brain Commerce platform is supposed to use AI to understand user intent and facilitate seamless transactions. They've acquired companies to bolster this, like SmartPay and SubSquid, to build out the data and payment infrastructure. In theory, it sounds fantastic. The problem is that this is an incredibly crowded and difficult space. They are competing not just with other startups, but with the built-in e-commerce engines of Amazon, Shopify, and the social media giants themselves. The expectation is that their technology is superior, but the reality is their financials show almost no market adoption. That $30 million in expected high-margin revenue for 2025 from the Group Buy acquisition is still just an expectation. It's not real until it appears on a quarterly report, and even then, it would barely make a dent in their $28 million quarterly loss. This brings us to the future outlook. What could possibly make this stock turn around, and what are the risks that send it to zero? The bull case, the one analysts are clinging to, rests entirely on that $200 million in new cash and the new management team. The expectation is that this new team, with its Apple and Microsoft pedigree, can execute a flawless sales strategy. The bull case assumes the Group Buy acquisition integrates perfectly and its revenues are real. The bull case believes the Agentic Commerce narrative will catch fire, and Rezolve will sign massive company-making deals with major retailers. In this scenario, the stock at $2.97 would look like a brilliant, gutsy call. It would mean that all of the online investment chatter was wrong, and the deep value hunters were right. But the bear case, which the chart is screaming at us, is far more tangible. The primary risk is the cash burn. Even with $200 million, how long can that last when you're losing over $28 million a quarter? That gives them at best a couple of years, assuming the burn rate doesn't increase as they hire this new global sales force. The second risk is further dilution. If the stock stays in the $2 to $3 range, any future capital raise will be devastating to shareholders. The third risk is competition and execution. The narrative is great, but they have to sell it. They have to prove their brain power LLM is better than the dozens of other AI solutions flooding the market. Right now, the market is treating Rezolve AI as an AI in name only. It's not getting the NVIDIA stock multiple, it's getting a distressed post-SPAC multiple. For a retail investor managing their own portfolio, perhaps on a SoFi trading platform or through Fidelity, this is a binary bet. It's the kind of stock that can make you 500% or make you lose 100%. Looking at this setup, with the story and the financials being so far apart, comment below. What do you trust more when you analyze a stock? The company's official press releases or the hard data from the financial statements? In summary, the tension here is as high as it gets. The expectation, fueled by a